Good day, Toby Lab from the Accounting Club, where we enable you and your business to succeed. Very quickly, I want to explain payment and account. If you have to do a tax return, or if you have done tax returns, you would have heard the term payment and account. If this is the first time you're doing a tax return, then you may need to understand and know what you will mean by payment and account. So a payment and account, it's a tax liability that is paid in advance, and I will explain that in detail. All right. It applies when your tax liability is greater than £1,000. So if your tax liability is greater than £1,000, or majority of your tax is from other income, then you would be subject to payment on account. Amount can be reduced if income is going to be lower. So as an example, if we know that in 2024-25 tax year, if we know that your income is going to be lower in 2025-26 tax year, it is possible to apply to reduce the amount of payment on account. If we do remove the payment on account, it can be removed, then interest will be payable. If your tax liability in the subsequent year is lower, then you will get a tax refund. All right. So how does it work? Right. So how does it work? So as an example now, let's say in the 2024-25 tax year, you have a tax liability of £2,000. That is your tax liability. HMRC will estimate that for the next year, which would be 2025-26, that your tax liability will also be £2,000. Okay, so where you know that your income in 2025-26 is going to be lower, your tax liability would be lower. So you can let us know, and then we can make an application adjustment to the amount of payment on account. So what this means is, rather, you have your current tax liability for the current year, 2024-25 is £2,000, but then you have to pay £4,000, not £2,000. You are paying £4,000 because HMRC is estimating your tax liability for the next tax year, and the estimate is kept at the same um, value as the previous year, as the current year, 2024-25. So again, instead of paying £2,000, you pay £4,000. All right. So in terms of when do you make the payment, right? You make the tax liability is usually due on or before the 31st of January. So your the tax liability for 24-25 is due on the 31st of on or before the 31st of January. For the payment on account, which is also £2,000, you pay that in in two installments, one in January and the second in July. So the one in January is usually called the first payment on account, and it is 50% of the estimated liability, in this case £1,000. The second payment is due in July, which is also 50%. Okay, so overall you're paying £4,000, but then in that £4,000 you're going to pay £3,000, made up of £2,000 plus £1,000 that is due on the 31st of January, and then another £1,000 due on or before the 31st of July. All right. So where your tax in most cases where you are a high earner or you have other income and your tax liability is greater than £1,000, the amount of tax, your tax liability, the amount of your tax liability is usually different to the amount that you pay because of payment on account. So I hope this has helped to provide a bit more understanding on payment on account. If you do have any issues or questions around your tax return or payment on account or your tax payment, do feel free to reach out to us, and we will be happy to help. Once again, Toby Lab from the Accounting Club, where we enable you and your business to succeed.